I think one of the things that's drastically underappreciated is I've always preferred, vanilla buy-to-let.
850 deals you've been involved in. What was your structure and how have you scaled to, over the course of your tenure, getting towards doing 1,000 deals?
First half a dozen, I was quite lucky in that I could remortgage my house and split the money between a number of deals, borrowed in some money from friends and family to start with as well to do those. And then I was out of money because the flip didn't work out apart from anything else.
What's your current thoughts on the market?
North's doing okay, Midlands doing okay, London, South East are struggling.
Just as a general note to anyone that's getting into the property space or is newer, the second you start to have to tweak the deal, as particularly starting out, that's not the deal for you. Your strategy has been to buy, refinance and hold. Were you always going into that, or was that kind of sculpted by some of your partners as well? Welcome back to another episode of the PBK podcast. Now, each and every week we bring a special guest to talk about all things property, business and everything in between. Today I have Adam Lawrence. How are you doing?
I'm well, thank you, Kazzy. Thanks for having me.
Thank you very much. Now, he was actually a personal recommendation, so we're going to blame Max if we don't enjoy today's guest, but I don't think that's going to be possible. Now, you got into property in 2011. Before then, worked in the UK in the betting space, wealth management, had worked over in Geneva. He is an Oxford graduate and through the joint venture strategy has now built a portfolio of over 60 million.
That's right.
60% loan to value, which I think is really important, and we're going to touch on that.
Yep.
And has transacted in over 850 properties in the UK.
Yeah.
Now, I think when we hear those numbers, and I always say this, when we start with the wow, the bit that's going to make sure you listen to the end of the podcast, some people are like, oh, that's so hard. Like, you must have started with 20 million to get started. So before we kind of go into your background, let's actually go straight into the property space. What was the first transaction that you did, like 2011?
First transaction, well, actually 2011, I did about 6 months of going out there, networking, kept the credit card at home, was aware of some of the traps that were out there back then. That space looks very different today, but
Still similar in some places.
There's more. You don't have to go to the events these days. They'll take it off you online or whatever. Absolutely. So actually, first investment purchase was 2012. First one that completed was supposed to be a flip. Bought it well, bungalow, but couldn't sell it. Market was still really flat. That was local to Birmingham, northeast Birmingham. So I had to rent it. And at the same time, was doing a few other deals. Created an HMO. I think we spent about £12,000 creating an HMO with fire. Can you imagine that? With fire doors and smokes and everything in there, and an extra bathroom in there, stuff like that. We had change. I know we had change out of 15 grand.
Different world.
Inflation is a thing, right? Definitely. But the standard of what was out there then was terrible. So there was a few bits going on at the same time. Couple of HMOs, a property that was converted into 2 flats that had been done illegally, but many years before, sort of thing. So decent, was going after yielding stuff, and the idea of the flip was to sort of rebuild the pot. So when that failed, wheels came off nearly straight away, really, to be honest.
So I guess, look, starting out, it still sounds like you had a really good base in property. So for example, the ability to know how to spot and appraise a deal, the ability to say, okay, I know a HMO is going to be high yielding. I know that there's going to be added value in something that has problems, i.e. an illegal conversion that you're going to use either, established use, laws to be able to legalize it and then add value. But all of these strategies, that's still a lot of information. How did you build up that information, have the confidence to then go and execute?
So I sort of, without realising even what a sales funnel was at the time, I picked a lot of the stuff from the top of various people's sales funnels, read the books. I like numbers. We were talking beforehand about numbers and things like that. I like numbers, so the numbers made sense to me. So I thought from the start, even back then, did we have enough houses in the UK? No. Were we building enough? No. What did that look like was going to happen? Because we'd had the crash, prices had come down, rents were really strong, rental market was super strong. So I thought, look, higher yield, and then how do you get yield? Those are all different ways of forcing a bit of yield, if you like. Because the thinking back then was that interest rates were going to go back up fairly quickly, which obviously didn't end up happening like that.
You mentioned really lacking numbers. How important do you think that is to being a successful property investor?
Well, I think it's difficult. If you don't like them, I think you've got to force yourself to like them a bit, or you've got to get a partner who likes them, or you've got to get a really trusted person who does, because, you know, the stuff that looks good, and I've sat and I've been asked to judge property awards and things like that. And when you're talking about a deal of the year, right, I think it comes down to the numbers. If you're talking about the best HMO, you might well incorporate design features and this and that and the other. But ultimately, I've always said, look, do the stuff that's sexy on a spreadsheet, right? That's for the stuff that's going to build a portfolio that's going to last.
How important are your spreadsheets to you?
What you mean? Don't take them away from me. Like, it's seriously important. I mean, you know, from the get-go. I mean, we still today kind of try and build from scratch when we look at a new project. So I don't like the template approach. It's fine for a sort of a first pass of a deal, but there's always something in there. You know, how long is it going to take? It's all about time. If you're trying to optimize something, are you better off to try and look at the people who do the trading stuff, you know, they're making money often before they've even bought it themselves, you know. So are they smarter to make 5K in an hour, or wait 9 months to make 45K? As long as you can make 5K every hour, then it's obviously the way forward, right?
And I think that's why, like, when people talk about numbers and talk about like the value and how good a deal is, it's so important to actually like annualize returns.
Oh, massively.
And also compare money in versus the return and risking, because making £50,000, you know, in 2 minutes, betting £50,000 on a roulette wheel is completely different. Even though your actual return technically is maybe, when you annualize it, you've done 1,000,000% for the year, your risk parameters, and I think that's why every deal has to be benchmarked between, okay, what's your return on investment? What was the risk you had to take? And then also, do you then annualize it to how long does it take you to make that money?
Absolutely. And I think the only thing I'd add to that, we're on the same page on that stuff, is how much effort you had to put in as well. Because there's so many different ways. Some are massive effort and some are really not. But only when you've been around for a long time or you've looked at a lot of different stuff do you see the difference in the, because you and I have only got so much effort we can put in, or so much headspace, or so much whatever else you want to call it. So effort is also important. Yeah,
no, massively. And I think that's anything that's finite, anything that your time, your effort, your expertise, like your appetite towards risk, anything that has a limited amount of, you have to value that commodity as if it was money, as if it was gold. Like, it has to be shared out very sparingly. What did you study at university?
So at my undergrad, I did philosophy, politics, and economics, which is the degree of chancellors and all the rest of it, right? You know,
you want, like, you know, if you want to see a smart man, firstly, look out. I think you've kind of tried to trick us though, because if I saw that T-shirt, I'd say that's not a smart man. That's a silly man in a smart man's disguise. But then you've told us that, you know, you've gone to do philosophy, economics, you know, and what else was
politics.
And politics at Oxford University. You know, I think you know, you're kind of a juxtaposition there. How did you find university?
I struggle with it, to be honest with you. So, and I think looking back, it was one of those. You'll be familiar probably with like astronaut syndrome or whatever you want to call it. I kind of set my goal on.
What? No, I'm not. What's astronaut syndrome? So
it's like once you've been into space, it's probably something you've looked forward to your whole life. They talk about it with Olympic gold medalists and stuff as well. It's like what comes after the space exploration or the Olympic gold? What else can anywhere near match that high sort of thing? And it's about goal. We talk about it in the context of goal setting. And, you know, my goal was to get in. And I got in, and it's probably easier than it should have been, to be honest. I was surprised how easily I got in. And then I didn't move my goals. I didn't have another goal. I didn't have mentor style characters or even people that in my network that I looked up to. I was on my own, and you know, my parents didn't go to university. They didn't really.
So you'd already won almost. Like
that was the problem.
I'd already won. I've already done the thing that, because for your mum now, it's like, there's my boy. He's at Oxford.
Exactly right.
Went you there? What then? He double checking. Is he still there? How's he doing? It's
yeah.
Yeah, he's still there. He's still at Oxford.
Yeah. So struck, and I wasn't. It wasn't really. It didn't feel like mostly they were my people as a general rule. That got a bit better as I got into second year. I went back to playing rugby. I played rugby when I was at school. I played rugby a few games for the county, so I was a reasonable player. But first year university, I just went very into myself because I just didn't feel comfortable, didn't feel at home. Second year, someone knocked on my door and said, like, you look like you can play rugby. We need someone. And went and played with the rugby team, captained the team after a while. That sort of moved my network along. So a lot of the people I still speak to are actually the people that I played rugby with.
And it's funny that how important doing, I guess, stuff like outside your primary vocation is for actually networking. And I talk about all the time in the property space. Like going to property networking events is great, but then a lot of the time, like everyone's doing the same thing. Sometimes you want to have something else that attracts people to you. So if you go to a networking event that's generally, I don't know, for like maybe doctors, I always use the example of people that are cash rich and time poor, and you're looking for investment. You've now got a niche that you're the property guy. Whereas if everybody's just the person at Oxford, you've kind of haven't created your own niche and your own USP. Today's episode is brought to you by Lendlord. And if you're serious about investing in property, you need to check them out. And best of all, it's free. It's an all-in-one platform for finding your next deal and also managing it in the long term. You can source properties from auctions and agents across the UK. Analyze any deal on Zoopla and Rightmove instantly using their Chrome extension, which includes BRRR, buy-to-let and flip metrics. You can even apply for bridging finance or a buy-to-let mortgage directly through the platform. Over 70,000 landlords are already using it, so head over to lendlord.io to create your free account now. The link is in the description. Now back to the video.
Totally agree. You're in the wrong room I always say, go where you speak the language. You know?
It's good advice. I guess I always like to try and give as much, tips for people as possible. If there is somebody that's maybe at university at the moment, but does feel a little bit lost, based on, someone's come out the other side and done really well, what advice would you have for them?
I would say almost certainly stick with it. A lot of what people understand from university, what are you saying? Because ultimately, especially in this country, you can do all sorts of degrees, and a lot of employers are looking at, have you got a degree? Have you not got a degree? They're not really looking too closely at what the degree is, because what does it prove? It proves you can show up. It proves you can get through a process. It just makes it easy for people to understand. And, I'm a big, although I've not worked long in corporates and things like that, I think especially when you're younger, going and working for somebody else that's got good structured training, that's going to put 2 or 3, some of these training programs now, like 3 years after university, those places are putting serious time, resources and effort into you. They're losing money on you during that time. And then you can take those skills and fly with them or do the side hustle thing.
Yeah, but I think that's why it is. And for me, like the idea of starting something and finishing and seeing it all the way through, when you don't have to, is probably one of the biggest takeaways from university as well. What's your current thoughts on the market?
Property market as it stands. Well, it's in 2 parts, I think, really, in as much as North's doing okay, Midlands doing okay, London, South East are struggling. There's a lot of outperformance probably in the last decade. I think in a way, when you zoom out a bit, it's quite incredible that we've had the interest rates go to where they've been, and the market hasn't been a bit harsher and fallen apart, really. The market's very resilient, it's very robust, but we're in a totally different place from where we were in sort of 2007. There's a lot less leverage. There's a lot more money. A lot of people don't need to sell. So there's a lot of stuff going on. Landlords trying to sell stuff. They don't hit the price they want. They go and rent it again. Kind of ignoring the renters' rights thing, to be honest, because they're not going to give their houses and flats away. Do you know what I mean? That they've worked for. So they can't hit the numbers. They're going back into the rental market. Obviously, we're not building enough. I could have said the same 15 years ago when I started out. That was obvious to me then. And there's been no year since then that we've built enough houses. So that's interesting. And there's big problems with new builds, with some of these high-risk buildings, stuff that goes on around London, things like that. 300,000 unbuilt pieces of permission at the moment as we stand, 300,000 units unbuilt. That's just mind-blowing, isn't it, really? And no wonder there's a housing shortage, right?
And I think the thing that's, and as much as there are so many issues with the UK housing market as a whole, there's just, when you look at it, like you said, you zoom out and you look at just basic supply and demand, there can be all of these issues, and there can be changes in tax law and legislation and renters reform and leaseholder reform and all these things that are going on that people are saying, oh, is so doom and gloom. But in actual fact, you have a product that the value remains because the supply side issue isn't being dealt with. So even if, you kind of want to sell, it's like, well, the rents are actually still performing so well that I can still justify holding on to the asset.
Yeah, and they're still moving upwards as well.
Yeah.
You know, even in all of the country, they're still moving upwards. Some places of the country, they're moving up dramatically, you know. But the market has to readjust to, ultimately, it costs more to deliver the product if you're using leverage. When it costs more to deliver a product, the price goes up. I mean, again, base comes back to supply and demand.
Just basic supply and demand, exactly that. Talking about delivering, and this is something because we've got someone now from the Midlands. Sometimes when I look at and I don't know if, and I'm like, are they lying to me? Or because I'm like, how are people building sometimes for so, at such a reduced cost than what I'm spending in London? Because I'm like, cost of living is still relatively outside of property prices. Is you're still going to the same Tesco.
Still going to Tesco. Yeah.
When you're buying your materials, you're still going to Wicks. There's not like a Wicks Midlands, because otherwise we'd be driving up there and driving back with our materials. So sometimes when I see this Liverpool, it's like, yeah, I've just done a HMO, 5 en-suites, and I've just spent £50,000. I'm like, pardon? How? What is talk to me? Is there a secret you're not telling us about in the Midlands? What's going on?
I don't think so. I mean, look, day rates in London are much higher. They just are. But whether that's supply of tradespeople these days as well, I don't know. There used to be a lot more tradespeople around London. There didn't used to be that sort of level of differential, as I recall, anyway. Whereas these days it's much more marked than it was. The Midlands actually is pretty well supplied for contractors. So you go a bit further north, you go into Yorkshire, you probably find it's more expensive.
Yeah.
Certainly bits of the northeast you go into, you find it's more expensive. We've got some properties up in Cumbria, and the thing is, Alan's Gas is the gas guy around there, the nearest gas guy for 20 miles. So Alan charges accordingly for the fact he's got a local
what Alan
monopoly.
wants. He's got a monopoly.
Exactly that. So there seems to be a nice sweet spot between enough people, but not such a high. I mean, it's difficult. You haven't got ULEZ, you haven't got all of those. You haven't got that base cost of everything.
Shall I tell you another one that people always underestimate? Just cost of parking.
Yeah.
There's some I do some more sort of zone 1 and 2 projects sometimes, and the contractors will say, look, there's no parking. You can't get a permit for the contractors.
Yeah.
So they're like, we're gonna budget £2,500 on this job for tickets.
For tickets
because they can't. There's not even paid parking.
No.
Because you can only park for a maximum of 4 hours.
Yeah.
And that parking, for example, if there's 10 roads in the close proximity that have pay and display.
Yeah.
There's one zone, so you can't park and move it to another road or another space.
Oh man.
So it's just part and parcel, I guess. There are these little intricacies.
Yeah.
And I think that's why when we talk about we're going to get onto this, but for you transacting on hundreds, pushing on, getting to thousands of deals, it's so difficult to be here's how you do a deal, because every deal has its own intricacies. And I want to hear your opinion on this. So I've got this statement. I say, deal analysis is more of an art form than a science.
Yeah.
Where do you stand on that?
Well, look, the numbers have got to work underneath it all. Yeah. There's no two ways about that. But I see your point with that. And some of that stuff we talked about, including things like effort, it's not all quantitative. You can't measure it all, right? Some of it is qualitative. And where's the variance as well? If you're looking to sell something at the end and you don't have another exit because you can't really keep it because the interest rate's too high or the yield's too low or whatever it comes down to, there's an element of variance in that. Yeah. Don't tweak your spreadsheet so it makes it work because you say, well, I'm pretty confident I can sell this above what the agents have told me. Probably not in this market, but there's definitely an art form. There is definitely an art form to it.
Just as a general note to anyone that's getting into the property space or is newer, the second you start to have to tweak the deal, as particularly starting out, that's not the deal for you. Because the second you've got to start saying, maybe I'll do it in 6 months rather than 9, so I'll reduce my bridging costs, or maybe it will sell for a little bit more, or maybe my refurb, that's hope value.
Yeah.
And it could happen. But generally speaking, you want to be relatively conservative with reasonable exits, reasonable build costs, reasonable costs of finance to allow the deal itself to make sense.
Totally agree.
I think that when I talk about the art side of things, it's because, say for example, and I don't know specifically, so I'm going to have to use the London as an example. So I may be offered 2 deals, and one could be in, I don't know, somewhere in southeast London, like Lewisham, where it's nice like demographic of people, but sort of, I guess you would say more working class, if that's like, whereas the same deal in somewhere like Chelsea or Fulham. Now, if the numbers are the same in terms of the return on investment and everything is pretty much the same, most people are like, oh, take the Chelsea deal because like, you know, it's higher ceiling potential. But if the numbers are the same and the ceiling price are roughly the same, I would take the deal in, I guess, the lower value area because I know that I'm not going to get as much headache from the residents. Like I'm not more likely to have a nicer conversation in terms of party wall. They're not going to be reporting my contractor because one time dust went on their car across the road and they've called environmental health.
Yeah.
But this all just comes from, I guess, years of doing things.
Yeah. So there is, I think, look, when we repeat things lots of times, heuristics are really important, you know, and a lot of the deals that we've done, they're really, really easy to value. And there's tons of stuff in auction that's easy to value, and there's tons of stuff that's hard to value. And the hard to value stuff is sometimes you can pick through that. It might be where the opportunities are, whereas everybody knows what 23 Acacia Avenue's like if every house on that side of the street has got the same footprint. You know, so it's a difference. And that variance is massive between the commodity. But you definitely get a feel when you've done it and appraisals thousands of times. You just look at it and go, probably not, or that's worth some time.
I think that's such a skill to be able to know where to spend your time, because someone sends you a sheet of like, oh, here's 20 opportunities. It's such a skill to be able to say, nope, maybe, nope, definitely, nope, maybe, and then spend a bit of time on the maybes. The yeses are, they're a guarantee that we'd be interested in them at this price if you can get that agreed. The maybes are often where your unicorn deals are, because when you can find that property that's been mismarketed, or it's not like the agent has missed a trick on it, so actually it said it's, I don't know, 600 square foot, but actually that doesn't include the basement, and the basement actually has full head height and there's a further 400 square foot. All of a sudden you're paying 60% below price per square foot just because of a little bit of misinformation. And like, I think if you're looking for your first opportunity, it's great to do the more quote unquote vanilla, like you said, 23 X Avenue. This is how much they worth. Here's the precedence of how much 25, 27 and 28 sold for. But because it's so obvious, a lot more people can do it. And so the margins are going to be eroded.
Sure. Yeah, we've had a few deals like that where we've had a free garage or a not listed and all sorts of stuff. I've seen deals where there's listed as a 2-bed and there's 4 bedrooms. I mean, it's amazing, but those are those unicorns. Yeah.
It's a good deal. So let's go back. So you've, like we said, 850 deals you've been involved in. Now, like I said, a lot of people would look at that and be like, you must have started with loads of money. What was your structure and how have you scaled from, starting out, looking at 1 or 2 opportunities to, over the course of your tenure, getting towards doing 1,000 deals?
So the first half a dozen, I was quite lucky in that I could remortgage my house and split the money between a number of deals, borrowed in some money from friends and family to start with as well to do those. And then I was out of money, pretty much, because the flip didn't work out apart from anything else.
Before we get into you going to how you dealt with running out of money, borrowing money from friends and family, talk to me about what that process is like.
Well, first of all, I think the easier it is for you, or the more you want to do it, the more you need to be careful. Because I've always had the same attitude. I used to hear things back when I used to go networking in 2011 and thought, that doesn't sound right to me. People talked about opium, other people's money, like opium. And I was like, I don't like that sound of that. It's got to be, I've always taken the same approach. You've got to treat it with more respect than you treat your own. And I'm pretty careful with my own, right? But that was always the way. And it was actually a conversation with my dad that really changed my mindset around it, because I was like, do I want to do this? It wasn't his money, so it was easy for him to say. He didn't have much money. But he said, look, you've got the ability to do this. I'd argue you might have an obligation to do it, because where do you want the returns to go? Do you want them to go to your family, or do you want them to go somewhere else? And I thought, wow, that's an eye-opening way of looking at it.
It's so interesting you say that, because I was always like, I'm not a salesman. So if someone says, oh, I've got this money, and I say, yeah, well, this is what I do. And that will be the last they'll ever hear from me.
Yeah.
But then what happened in 2022 was, had a friend of mine who's, I got this money. And I was like, oh yeah, this is what I do. and didn't hear from him, didn't hard sell him, or not like, but didn't really even explain in any more detail how
Yep.
we could work together. Fast forward 2024, he's this person who I'm not going to name, he's invested 100K with him and he's lost the money. And it's that same thing of like, if you know what you do is good, you've almost got that obligation to a degree to be like, actually, if I know I can help somebody, why am I almost being a little bit shy and coy and being like, oh, I don't want to ask, I don't want to push a little bit, because you genuinely know the product or the offering has value and you're not asking for a favor from these people. You're presenting an opportunity that is mutually beneficial.
Look, I think that imposter syndrome bit or whatever it is, that it's a powerful thing if you've got it, because you're always sitting, as happens to me all the time these days, when someone introduces me for something, I think, it doesn't feel like me. I don't look at myself like that in the mirror in the morning, you know, but when you think about track records and things like that and say, well, look, I can show you that I've done that. And like you, I'm not a salesperson, but if I'm passionate about the product and I know it's good, then I can talk to people about it with at least an air of authority. And that's very helpful, I think. And like you say, it can help protect. I've dealt with many people who said, I've lent money to X and Y and people who won't be named. And my usual advice has been, just try and get it back as soon as you can. Yeah. And it's helped quite a few of them get money back from people who've then gone insolvent and things like that, which I've been more than pleased to do.
Yeah, no, definitely. I think, look, like, and top level, it's do your due diligence if you're going to work with anyone, like, and that includes us. Like, 100%. If you're going to work with either of us, my thing is, ask me any questions. Go and ask people that know us. Do your company's house. There's a lot more data available there now as well.
Yeah,
have all of the conversations. You know, there's a lot more data out there on people now. Like, you can see the builders that I work with. Are they getting paid on a regular basis?
Yeah.
The people that I'm saying, oh, this person we've just done a deal with, are they happy with how things turned out?
Yeah.
So if you are looking, you know, and this isn't like a pitch at all, but it's just genuinely saying, like, if you're looking at doing investment or opportunities like that with anybody, just make sure if something looks and sounds and feels too good, it probably is. So do your own due diligence.
And look, can I share something that might be useful to
sure.
the audience? So one of the things I did early on was when it came to needing to borrow money in, I showed them projects that I'd done and said, look, this is bringing in this cash flow. So I'm not taking this cash flow out. I was incorporated very, very early on. So I was convinced. And it was to do with the mortgage landscape at the time. It wasn't because I saw Section 24 come in or anything like that. But I could show them the business and say, look, I can live without taking this money out of the business. So I've got this money to service debt, right? So that's where I'm going to pay you from. I'm not going to pay you from this project that may or may not work out. There's a project that's already worked out. It's producing this cash flow. I'm not going to borrow against all of that cash flow because that would not be sensible, but I can put a percentage of that cash flow aside to service a loan. And that's how, and it really made it really simple for people.
And I think that's what, like, I've always looked at things and said, look, I can have this upcoming project, but if we're not, like, and obviously, like, if you're a JV partner, it's slightly different, but from a straight, like, just debt perspective, it's like, this upcoming project is great, but realistically, if the collective existing assets can already service any additional lending, then, and with all that, so you have to caveat that all investment carries risks, but it does dramatically de-risk it if you're not wholly reliant on this brand new venture covering any potential, you know, losses or anything that could go wrong. But I think it's really important because the OPM, like the other people's money, is something that's massively pitched and like raised money. And it's great because it's important to obviously raise investment to be able to scale. But I think everything that you've alluded to, that you need to make sure you have the ethics that say that you're going to take the same level or less risk you would take with operating with somebody else's funds and treat it like your own. And for me personally, particularly when you're starting out, I don't like the idea of 100% OPM. I think you need skin in the game to keep you accountable.
Yeah, I mean, 100% leverage, which a lot of people do, obviously, and a fair few people do teach as the way forward because they're kind of pitching to people who've got no money, but they've got time, they've got hunger, they've got skills, whatever. I agree with you. It's very difficult. I actually stack my deals based on borrowing 100%, but that's more of a protection measure to see that it stacks up. Because I always look at it as if I can't borrow 100%, it's probably not a deal that I want to be doing at this point in time. So it's a sort of real rule of thumb way of not getting involved in something
you use that as like a stress test.
Yeah, basically. Yeah. Is the juice worth the squeeze? That's one of the little dip tests that I will do, basically.
No, for sure. That's really good. Okay, so after obviously realizing run out of money quite quickly, even from like local friends and family and people that know, like, and trust you, how did you then go on to scale? Because doing, like you said, 6 deals all the way up to 600 plus, big difference.
Yeah, so I knew I needed equity partners realistically. Probably rushed into the equity space a bit too quickly and didn't try and raise enough debt, to be honest. But
and just for those, because obviously we've got loads of different people at different areas. Talk to people about the difference between what is an equity partner versus raising money through debt.
So what an equity partner should be is someone who understands exactly what you just said. Investment carries risk.
Exactly.
So if we do well, we're sharing the upside. If we do badly, we're sharing the downside, right? Whereas debt is going to be an obligation to pay that ultimately you're going to have to take seriously. And if you don't, you could be insolvent. If you go insolvent, you'll struggle to ever get insurance, get any other lending, all the rest of that sort of stuff. So that's the broader difference. So therefore, equity returns should be better than debt returns. What a lot of people teach is, they don't say it like this, but what they teach is to take debt, but that debt really is equity, because you can't get 100% debt on a deal. So if you're using 100% debt, some of that is equity. You're calling it debt. Am I making sense? Do you follow that? Or
so it's like, I guess, well, yeah, like I understand in principle, it's just to try and explain to people.
I suppose I'm talking about pricing, really. You know, the last 10% on a deal or last 5% on a deal should be making a return of 25, 50% a year or whatever. But the first 60% should probably be making 5% a year. So there's a very big difference, because it's ultimately the order in which you get paid if something goes wrong, isn't it? So went into raising equity in a big way, which was good, because raising equity didn't provide this drag against the companies that if you do it with 100% debt, as some people do, you need significant cash flow to be able to service that debt. Even if you're not servicing it today, at some point in the future, you're going to, even if you get a 5-year, a 10-year, 15-year loan, at some point you need to pay it back, right?
And I think that's the thing that I found with quite a lot of people, that they don't, the long-term planning in terms of, they don't see property in the same way you see other businesses, in that cash flow is king.
Yeah.
So that they do all of this upfront loading when it comes to lending and borrowing and JVs. Then 18, 24 months down the line, when everyone's like, okay, so when are we getting paid? Where's this?
Yeah.
So you're paying me, but you still owe me £50,000, even though we've exited because we had to leave money in the deal.
Yeah.
And there isn't that actual cash flow forecasting. And I think if I was to offer some advice to somebody, particularly starting out, would be to run your cash flow forecasting as if it was any other business. Because if you were running a bakery and you knew that, okay, well, we take this up front, we've got 0% finance for like 12 months on all our machinery, but then in 12 months' time, we've got to start paying this amount. You know how many cakes you have to sell in 12 months' time. And if you don't think it's realistic to sell that many cakes, you wouldn't start the business.
No.
And I think you need this. I almost feel like, and this is a question I want to ask people, start asking people more. Do you think people view property differently to the way they view other businesses?
Well, they definitely, I mean, look, there's a good reason to view investment businesses differently from trading businesses like a bakery. You know, the top heavy way, the money's in the assets, the balance sheet is much more meaningful normally. But you're right in that the cash flow is still going to sink you if you can't make those demands when you need to make them. Well, we've also seen massive companies go down because of relatively small and certainly big developments and big investment companies. One little loan that's not paid, one creditor that gets annoyed, that can send it down. If you haven't got that money there and then, it's problematic. So I think people do, but I think they also they believe, there's a lot more belief than there is in maybe a bakery. Not many people sort of wake up and think, I know that people are going to want these baked goods their whole life, sort of thing, you know. Whereas property,
open a bakery next to me, and I think you'll be all right. You know, little croissant every morning, long as croissant every morning, maybe a little Belgian bun in the evening. If that can keep you in business, you'll be all right if you open next to me.
All those budding bakery entrepreneurs out there, take note.
Exactly that. So okay, so you started to get equity partners. When getting a joint venture partner, we're going to kind of start to sort of use the same terminology.
Yep.
What do you think is important in terms of the conversations you have with them for it to work?
Oh, look, it's like getting married to someone ultimately. You're putting your credit rating on the line. You're putting an awful lot of faith in that person. So number one, like, are you on the same page? And you can probably start with values, because the values aren't aligned. There's a problem. You're just kicking a can down a road, realistically. Then I'd probably move on to like time horizon. So what's their expectation? I've had really simple, we were talking earlier about, being straightforward with people. And I've had people say to me, look, I don't want to see, need, or care about this money for 10 or 20 years. And then I want to start drawing down from it. Or I want to sell the company or sell the properties or however it works. Easy to work with, right? Because again, your cash flow forecasting and your models are going out those 10 and 20 years and saying, well, by then we should be able to be here, right? And then you start talking about loan to values and things like that, So being on the same page like that, not just jumping at it, probably not starting a JV with someone you met at the nearest property meeting or whatever, especially not if they're the same as you, because you're not going to add that bit of value. Do you know what I mean? I'm much better off in the spreadsheets and the financing and that side of things than I am trying to do the operational building side of things. I don't love it. I'm not very good project manager. It's not my skill set, So so you need to find people who are going to do that. So
complementary.
The classic sort of builder investor is a classic JV that you see. The difficulty I've seen with those over the years, including an early one that I did, is the builder didn't think the investor was adding value and the investor didn't think the builder was adding value. So you've really got to understand each other's language. Where are you taking money from and when? You've got to have that conversation, because if one of you says, well, I had a guy once say, look, I'm going to need $5,000 a month from the start. And I'm like, you're talking about raising capital. You want to take $5,000 a month from the start. What are we going to take? That makes me think as a partner, well, should I be taking $5,000 a month? I don't need to. I don't want to. But this business is going to sink before it starts, because you're just going to be in a sinkhole of debt, because ultimately you're going to plow money into projects that you're then going to optimize and you're then going to start getting money back. But if you need that $5,000 a month in your spreadsheet from day one, go back to your bakery example or whatever, you're dragging things down from the start. So
you're eating all your cherry bakewells.
Before Mr. Kipling's even had a chance.
Exactly.
Absolutely.
But, and that's why I think it's so important to just have those really open and honest conversations, because like I've had instances where I've had partners in things and I've not understood that my requirements, with them being married with 3 kids and me not having any dependents, are completely different. I don't need the money and you do. And it's not a case of you're wrong for it. No. But where we're both wrong is we didn't have the honest and transparent conversation on day one, so we know where we're at.
You learn from experience, right, in those. And I've definitely learned. To say I've been perfect in those from day one would be a lie, Cassie. It'd be a lie.
Did you always, obviously your strategy has been to buy, refinance and hold. Yeah. Were you always going into that, or was that kind of sculpted by some of your partners as well?
Good question. So that's really before it was even called BRR or whatever it gets called these days. That was the plan. It was always tax efficient. It was what I wanted to do. My partners have always pretty much been happy to or trusted my judgment. And as the sort of frictional costs of buying and selling go up, as they have been going up over the last few years, it makes more and more sense, really. But it's that patience part, especially when you had a few years where maybe capital growth hasn't been that special, that you need that. But largely speaking, they let me drive the strategy. And the occasional one who says, like, why haven't we bought, we've got this money waiting in the bank, why haven't we bought the property this month? I will normally push back and say to them, let me do that. Do you want me to buy something average? Yeah. Are we here to buy something average? I'm here to add serious value, to buy something really good that you couldn't buy on your own. Because your alternative is you go and do it on your own, right?
Do most of your partners have property experience, or they come from other industries?
No, so the majority are in other industries. They're normally more likely to be income-rich, time-poor sort of characters. Yeah. In fact, I worked with a couple of guys who, one was one of the best qualified building surveyors, chartered builders, everything that you can imagine. It was like my first mentor, really. So for me, that was about me getting the skills and then me raising the capital and looking after the financing side of the business. But these days, very much more, what do I need? Capital, usually equity, because it's going to take the pressure off the P&L in the first few years while we build the base. Then once we've got the base, we can start building on top of the base, I
think it's difficult like now, and particularly, obviously, you mentioned your overall portfolio is at 60%, which is very viable in this market. A lot of people are at the 70 to 75%, which if they were doing build to rent schemes, all of a sudden the scheme was non-viable. They now had to sell. The stabilization period of the asset wasn't realistic anymore. So, there's, I think that there's a lot to be said for acting in a way that works in the sunshine and in the rain. I think a lot of, whether it's gurus or expert, pick strategies that work really well, and they're going to make you could potentially make loads of money when things are going well. But the second there's a slight tweak, a slight movement, interest rates move, swap rates are moving or are more volatile, all of a sudden you have a lot of people that fall out of the bottom of the market.
Yeah, well, and that's one of the reasons why when we talked earlier on about risks and things like that, I think one of the things that's drastically underappreciated is I've always preferred, vanilla buy to let while the returns can make sense. Because if you want to sell it, again, going back to those commoditized houses, you know what it's worth.
Yeah.
You know what you need to put it on the market for. You know what you need to do. You know what you need to achieve. You're pretty sure you're going to sell it within a fair enough time period. If it's a really difficult asset, like it's a service accommodation in the Lake District or something like that, who's your buyer? What does your buyer look like? You've always got to think about these things when you sell anything, haven't you?
Nice.
So if you don't have an exit door, if you're making more money out of that, which you should be, cash flow wise, how much more effort are you putting in?
Yeah.
But how much more risk are you taking? And if you have to liquidate it, what does it look like? And that's a long learned lesson.
Yeah. I think that's why it's so important to constantly be doing portfolio appraisal and looking at, okay, so like you said, we'll use the example of a cabin in the Lake District. It's absolutely smashing it on Airbnb. It's outperforming anything in the area and anything in your portfolio. But if it's doing that well, but it has an element of risk, to balance the books on that specific asset, why not de-risk it? Let's actually pay back some of the capital on that one, just because, they're talking about, let's say, bringing in, what was they talking about? Bringing like a tourism tax on potentially on the serviced accommodation model.
Yeah.
All of a sudden, then that affects your bottom line and affects the actual value of the asset because it's effectively linked to yield. So I think it's so important to be A, aware of what's going on in the market, and B, take that learning and apply it to your portfolio.
I couldn't agree more. I think that's spot on, and that level of understanding of what might change, or looking at the downside risk, doing a SWOT analysis, however you go about doing that, or maybe holding a bigger cash buffer because let's say the weather goes bad over a winter and you don't have anywhere near the sort of level of trade that you thought, and you burn through 3 months worth of
you see,
bills.
The PTSD that I have. You see, when you said the weather goes bad, as a property investor, all I think is roofs. Don't get me started with these roofs, because they're that thing. There's no problem with them until there is. And then all the roofers are busy because everybody's roof has gone bad at once. And I'm not going to go up on the roof and check it. So now I've got some cowboy that I don't know has done half a roof. I've gone up there and found tarpaulins on a roof that they said I've paid for and has been finished.
Well, you said earlier on about what's the secret of properties and why is it so much cheaper in the Midlands and things like that. Roofs are still, if you've got more units, you've got more roofs, you've got more boilers to worry about. So believe me, when I hear storm, Kazi or whatever, it's not a happy day in the Lawrence household.
So when it's really pissing down, I think to myself, I just start looking around. I'm thinking, don't you dare.
Yeah.
Don't you dare. Yeah. In terms of this portfolio that you've built, have you specialized? I know you said a lot of single units, but have you gone into serviced accommodation, student accommodation, or HMOs, commercial? Where have you ventured into?
So student, very, very little.
Yeah.
And that's kind
of
thoughts
on student accommodation?
Well, I've been pretty bearish on it for years, to be honest. I look at the yields of the big stuff, the PBSA stuff, and I can't understand them. I can't make sense of them. I don't want a bar of that. Right, just because it's I've always felt the same way. Just because it's going to get valued at X, that's not the value to me, right? I would rather be involved in somewhere where the yield, perhaps it's going to get valued at a horribly high yield, but actually I think it's a bit better than that. And I've also got the yield to protect me as well. So I've always been at the other end of the student side of things. And there's all sorts of risks. Going back to the risks you were talking about, there's risks of the next election. There's risks about immigration rules, risks about all sorts of things. There's risks that university AI, who knows? Who knows what then? Graduates aren't getting jobs.
And even without that, I just look at it and I say, because it's linked on, it's basically just a yield-based product. But if interest rates go up and I don't want it anymore because it doesn't work, nobody's going to want it. And that's my only it's either going to really win or win lose.
Yeah.
And you can't really de-risk it unless you build ground up yourself and do everything and then have created the value day one.
Yeah.
It's the only side of things where I think,
it's a good way of looking at it. You're taking a view on the risk-free rate of return, whether you realise you are or you're not. So commercial a little bit, especially we bought quite a big commercial site in 2020 when COVID was on. Incredible good value. Half of it, all sorts of stuff on the site, serviced office, leisure, industrial. And it was a lockdown opportunity. And that was an asset management sort of play. Enjoyed doing that. Quite a few moving parts in it. There's still quite a lot to think about, but a really good learning and a really, really strong cash flower. So you got to like that realistically. Serviced, I've only ever really done it. I did it when I was selling a block of flats, and it's a bit of a convoluted deal, but it was an exchange with delayed completion subject to vacant possession with a 6-month window. So when we were coming up to exchange, to set a couple of the units up as short let. And they did really well. They did really, really well, much better than I thought they were going to do. And it did make me think, should I do that in that? And it really wasn't an area where you would have thought it would have worked, but it did definitely served a purpose. But I've got a few, and they are in places where, a bit like you said earlier on, the asset works. It's not that exciting if you had it as a single let, but it works. But with the SA layered in there, it's actually generating some pretty good money. So perhaps there's a big infrastructure project nearby. And therefore, there's lots of contractors. It's those sorts of bookings. I just had one that's been booked out for a year. Those sort of at the full rate. And it's like, those are the unicorns that, well, actually, I'm just getting double. I'm getting more than double what I should out of that for the next year. So that covers the volatility piece of all of that. But ultimately, as private rents have crept up or shot up to an extent, SA rents haven't really moved like that, and therefore you've seen a rebalancing of the difference between the two.
And it's back to that basic supply and demand. A lot more people are doing SA from rental arbitrage as opposed to like buying units and renting them. So there's a lot more properties available on the platforms, Airbnb, Booking.com, whereas there's still not loads more properties being built, and actually some of the rental stock is being taken away and moved over, which means prices. And I think that's where, again, I think it's so important when people ask me, you went to university and you never really worked in the field, do you think it was worth it? Like me doing economics and just being able to look at just base level economic principles of supply and demand is so beneficial to business as a whole.
You're never going to hear me disagree with that. I talk about economics all day, every day. It's been. I mean,
look at the top. He's got. He's made sure. It's like, when he was on the tube, he was like, "Anyone want to talk maths? I'm around. Anyone want to talk economics? I'm here."
Pretty quiet on there, to be honest. Pretty quiet. Yeah.
Fair. Couldn't strike up a conversation about anything marginal utility or anything interesting. Couldn't be like anybody like quants. Fairs. What's your thoughts on HMOs?
So I did them early on, and I've got a lot that are HMOs, but they're leased to providers. So I think
what type? Because I think there's lots of different types of provider.
Yeah, there are.
Because the provider that's just John, who's guaranteed rent, versus like a Serco versus 15 years index-linked leases. What kind of providers do you have?
Not supported social. None of those really good leases, unfortunately. They're more like 3, 5, 7 year leases. All the way from the blue chips down to not John. No.
Nothing against John.
I work with John, but John needs to put a very big deposit down that John doesn't normally have, to be honest. And I tell John that very, very, very straightforwardly. All the way down to maybe smaller housing trusts, housing charities, things like that. So that's the sort of range, if you like. Some RP, some for profit, some not. That's that sort of blend. And ultimately, I mean, 2022, I was very, very glad I was doing all that when we're watching utility prices do a little bit about what they're doing at the moment, to be honest. And you think, well, I've taken that risk out of that. So my net is as good. And if you run HMOs well, professional HMOs, I think the hard bit is having one, right? Because 10 means you can probably employ John, let's call him again, who's going to be nearly full-time on the portfolio. And you're providing a really great level of service doing that. Can you do that 100? Maybe, but then you start getting a bit more corporate and thinking, well, we can stretch John across 20 houses there, and maybe the level of service drops a little bit and you get a bit more accountancy. But I think, look, they work their effort again. Do you like that side of things? I always encourage people to look at the bits that they're doing. I remember when I was spending maybe 30% of my time on management, that's when I decided I wanted to get into buying a letting agency or starting a letting agency, because I was measuring my time and looking and thinking, someone else can do this. And actually, if I look hard enough, someone who enjoys that, I don't enjoy that bit, someone who enjoys it can do that. And that's what happens these days in the portfolio, you know. So I don't mind them, but, you know, they're not the silver bullet. Gross to net is the key conversation, really, isn't it, to be honest?
So am I right in saying then, is if you were to pick like an area to focus on going forward, I know you're a big fan of diversification.
Yeah.
But are you still a fan of the single unit lets? Is that where would you say you're at?
It gets to be location dependent these days, doesn't it? Because if they're not, and this is about where your base costs are. You know, my base costs are quite high because I've got a team looking after things, right? If you're looking after everything yourself, you can keep your base costs right down. But do you want to keep your base costs down just so you can eke out a tiny margin out of a single buy to let every month? I think you want to be in an area where you believe in the capital growth over the next 5 years, and you believe in the rental growth, and you've got some margin. So there's obviously bits of London where it's very, very difficult to hold on to property these days. And you might say, look, it's unencumbered. I've had it for years. I don't want to pay the capital gains tax. All of these are relevant conversations. But if you're looking to add to a portfolio, it's kind of difficult to do it anywhere near central London these days if you're going to use leverage. And if you're not going to use leverage, unless you feel prices have been depressed for maybe nearly 10 years now, they're going to rocket upwards. You're taking a view there. It's not necessarily a view that I would share, but you're taking a view on that, and that makes sense. And frictional costs are a deal when you already own stuff, aren't they? But if you're buying it in, so definitely works, but location dependent these days, I think.
There's a couple more questions before we let you go. Speaking to people starting out, like now in property, right? Like a lot of them are like, interest rates are high, cost of living is so high, you know, everything, Section 24, like, you know, the Renters Reform Act, all of these things that are all reasons to not get started in property. Given a choice, if you were starting now and hadn't had any property investment experience, would you still invest in property in this market?
I definitely would. But that is, again, back to the people don't appreciate the low risk, medium to high return you can get in property. So you've got to look at these things. A lot of people often, if they're thinking about starting out, they might also be thinking about starting an Amazon fulfillment business or getting involved in crypto. And what you said earlier on about risk is so important about all of that. May as well go to the roulette wheel with that sort of attitude if they've got some money saved up. So you've got to have the same qualities you've always got. You've got to be patient, right? If you're expecting it to happen like that, if you think it's get rich quick, look somewhere else. It's never been get rich quick, never will be. If it get rich slow, is it still going to work? Get rich slow. Property is cheap today when you look at inflation adjusted, when you look at wages. And regardless of interest rate wobbles and swap rate wobbles and things like that, the longer term future is probably lower interest rates again. Not where it was, not where it was sort of, 2010 to 2009 to 2021, but it's still going to be lower. The structural stuff you already talked about in the market is undeniable. Do we think that, unless you're taking a view, the population of the UK is going to start shrinking? Seems unlikely in today's world, so it's going to get older and people are going to stay alive for longer. So even if people aren't being born, population still goes up, for the foreseeable future anyway. So the fundamentals are better than when I ever started. And the stuff you just listed, ultimately, that's all reasons why people want to sell stuff or do deals in stuff at the moment. That creates opportunity if you look at it through the right lens. So there are more. I've heard for years people talking to people about find tired landlords and stuff like that. There are a lot more tired landlords out there today than there were when I first heard that phrase 10 years ago,
Exactly. And I think, and that's the thing for me, like I understand completely, not everything is for everyone at every point in time, but at any point in time, you can find a reason not to do something. But also, if you're looking at it as an entrepreneur or as an investor, there's always a reason to do something, and they're the things that you've got to focus on.
Absolutely.
You look at interest rates at the moment, they're stayed the same, but they're going up in terms of if there's an upward trend over the last couple of years. Take it back 10 years, 20 years, actually interest rates are really competitive.
Yeah.
And it just depends on how you want to baseline what a good deal looks like, and also how you're going to use your existing skill set to operate within the market. You've built a portfolio, hundreds and hundreds of units across the UK based on investment opportunities that you've seen that, present a good deal for you. I'm going to give you two sort of areas to talk about now. So for example, Ireland is somewhere that's always had, not always, recently over the last 5 years has had really high rates of return. Also, for example, somewhere like Dubai, again, the market has been really strong. Have you diversified outside of the UK, and if not, why?
So I'll do them in reverse order. I've been to both markets to have a look at them. Couldn't really make sense of the Dubai market and the return. So when am I talking about? Maybe 2-3 years ago. Probably would have seen that shoot up quite a bit, and then very recently it's taken a big haircut with what's been going on in the Middle East. Frothy stuff. I look at fundamentals. I'm pretty boring maths-based guy, right? So when I'm looking at the fundamentals, I'm thinking, what's coming in here? Who's coming into Dubai? Obviously, they're attracting money from all over the world. How long can that last? I don't really know. I don't really have a view on all of that. How many units are they building? When you look around, it's a lot. How do you
70% of their market is primary, so new build market.
Yeah, you look at what happened in China when they overbuilt before the population adjusted to that.
Ghost cities.
What happens if an event occurs, as now has occurred? Huge volatility. So again, you're introducing mass volatility. I'm not a huge believer in the primary market, in terms of adding value. Developers are clever. They're very, very good at extracting value. If you look at new builds from the last 10 years that have then been sold in the secondary market, people have usually lost money.
Yeah.
Now, some of that is maybe because London hasn't been that exciting over the last 10 years, but you can you can have that conversation in the Midlands. It's still the same, still the truth.
You can have that conversation again, last 20 years, if you're honest, because a lot of the build up to the credit, the financial crisis, was also a lot of new builds stopped being oversold and overpriced.
Agreed. Off-plan worked while the market was going up like a rocket. As soon as it wasn't, it didn't work anymore. And I think developers have got smarter about extracting all the value out of it as well. So high risk, reasonable return. Do I want to move to Dubai or something like that? Not really. So do I therefore want the currency exposure to effectively the dollar? It's another risk. So I'm going to need more return. If I'm going to say I've got higher risk, I've got higher return, I've got lower level of control, and I've definitely got a lower level of expertise. I'm not seeing a reason in there for me to move and get involved in any of that stuff. Ireland, I think you probably see what had happened coming a lot more easily because the low corporation tax, the Google, the structural issues in the Dublin market, specifically with building and things like that, much more. But now they have 6-year tenancies. So legislation is something that's always a risk, and you could argue it's been a risk in England and Wales and Scotland and everything, although I've got my own views on that and I've done a fair bit. I've obviously got a better working knowledge of all of that. Again, you've got currency exposure to think about, and you're starting from a brand new, fresh network. You've got to have a really strong view about somewhere. And I think you want to have a view that I've always had the same sort of mantra. I don't really want to buy anything that I wouldn't live in myself. If my life was different, if the train came off the tracks, if I got divorced, if whatever, would I go and live there? If I could have put my head down there for the night and be happy, and I could actually have a good night's sleep. And all those extra unknowns that come in, I would want more return or a real reason to go and do all of that. And I don't really ultimately have that at the moment.
I think that's really interesting because I get asked a lot about different areas and why haven't you invested here and why haven't you invested there? And I say, there's still so much going on where I am. Even to leave London. So that's my conversation. When someone said, to come and invest in the Midlands, I'm like, it's not a market that I have enough expertise on to get as much value out of it. Like I said, to extract the value, to use your words. So whilst I'm sure there's great opportunities everywhere, there's great opportunities somewhere in South Sudan probably. But do I understand it? Not in the slightest. So someone can come and sell you on it, but the second you're being sold, you're just being sold that dream, as opposed to, I'm going to be the person to make the value. You're just hoping that somebody is going to give and deliver you the value. So if someone is looking at getting into property, I would really strongly advise them to focus on an area where they have a level of expertise that gives them more control on adding value to the asset.
Absolutely. And flip it on its head. How many people who live overseas, and I'm not just talking about expats here, but invest back in the UK, want their money in the UK. Why? Strong legal framework, apart from anything else. Politically stable. I might regret those words at some point in the future, hopefully not, but politically more stable
we've
than
been
a
all right
lot of
at fence
regimes.
sitting for a little while. I think we're doing all right. But also just market stability. The market has so much history and heritage that you can extract the values for such a long period of time that, we use Dubai as an example. I think assuming that this is another market correction, it's going to be number 5, I believe, in 25 years of full market corrections. So, it's, you just look at the market, you look at the model, and I think you just have to follow where the information is. It's been an amazing conversation with you. I'm sure loads of people are going to want to pick your brain. There's going to be some maths geniuses that will be like, finally, I found my 1 in 1,000 mates that want to talk to you. If people want to connect with you, how can they get in touch?
So best way is on LinkedIn.
Yeah.
LinkedIn, Adam Lawrence is the best way. I do have my own YouTube, Proponomics with Adam Lawrence.
Okay, amazing.
Property and economics mixed together. So
you've already sold a subscriber. You guarantee you're going to go up to 2 tomorrow.
Top man, I appreciate that. But it's an important 2. That's the thing, Cassie. So those are the best ways. I always try and respond to the YouTube comments, and I get back to the LinkedIn messages as well.
Amazing. So. Now, it's been really, really good to connect with you. I've thoroughly enjoyed myself. We are going to be back next week. Another guest, another amazing conversation, loads of value, loads of tips, loads of hints. So if you haven't already, make sure you subscribe. I'm going to be back next week. Peace.